Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-string support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. As we head into the Easter weekend, this week's podcast actually marks the 6th anniversary since the podcast was launched. Back then, it was the COVID pandemic that was sending jitters right through the market. Today, it's Donald Trump and his Iran war. It's the 5th week of the war, and it's been another yo-yo week with different pronouncements coming out of the White House on a daily basis. Are we heading for a ceasefire or an end to the hostilities, or is President Trump going to use his military forces to try and wrest back control of this particular conflict? Well, we don't know. I don't know anyway. But this week I'm talking to two guests whose job is to navigate these kind of markets, and I thought it would be useful, therefore, to get their perspectives on how things are going and what they are doing about it. So first I talked to Jasmine Yeo, who is the manager of the Ruffer Investment Trust, ticker RICA, which is one of a small number of what we call absolute return trusts that aim to preserve shareholders' capital through good times and bad, and grind out a positive return across the cycle that is at least twice the rate you can get on cash at the bank. Secondly, I then go on to talk to Charlie Morris, who has been on the podcast before, a well-known former fund manager at HSBC, who now runs his own research boutique and specializes not just in gold and Bitcoin, two particular interests of his, but also in running model portfolios with different risk characteristics for clients of his firm, Bytetree Research. So just looking at the performance of the markets this week, well, if we look at the investment trust sector, which is our main focus, we see the number of gainers outnumbering the number of decliners over the week, something that's not been the case for the last 4 weeks. And that marks, in part, a rally in the equity markets early in the week when President Trump hinted that it would all be over within 2 to 3 weeks. Well, he followed up with another much more aggressive stance in his big speech on Wednesday evening. So there we go, continued volatility and a lot of things for investors to manage. So let's crack into it. This seems a very good moment to be talking to the manager of the Ruffer Investment Company, the absolute return fund, I think I can call it that, which is listed on the market, has been for more than 20 years now, I think, as a market cap of somewhere between 800 and 900 million. And I'm happy to say also had a good year last year by your own criteria. Positive double-digit NAV total return in a year which was full of a lot of things going on, shall we say. So, Jasmine, the first question that I'll ask you is just sum up how that last year has been, the first one you've been as the lead fund manager of the trust. Tell me how it's been for you, what you made of it all, and how you managed to steer your way through to this positive result.
It was very kind of you to start in such a positive place. Absolutely. I think 2025 was basically a great case study year for the Ruffer strategy. It's exactly what we aim to deliver to shareholders, which, as you describe, is consistent positive returns through what can be sometimes very volatile financial markets. As you say, double-digit NAV and share price return. And I think the key thing for us to highlight is the consistency of that return, because last year was defined by probably 3 very different market environments. Initially, January and February, it was all about that equity market rotation, actually quite similar to the start of 2026. And it was great to see our equity book, which is largely focused outside of the US, more towards rest of world flavours. And so that delivered a couple of percent for us in the early innings of 2025. Then what was really interesting as we came through towards the spring, that sort of March and particularly April period, where you had significant volatility as a result.
Liberation Day and all that.
Exactly, but very much so. At that point, it was very different parts of the portfolio that started to work. So still delivering a steady positive return, but it was the protection strategies within the portfolio that were doing the heavy lifting there at a time when equity markets, actually in bond markets as well, were falling at the same time. I think almost as importantly, the trust then continued as markets recovered through the rest of the year, and particularly the second half. It was a strong period for risk assets, and we continue to capture some of that recovery. And that is exactly what we should be doing for shareholders, delivering a meaningful positive return, but whilst carrying significant amounts of protection, so that moments when it's required, which of course you can never perfectly time, it's in the portfolio and will deliver those gains, perhaps when it's most important for investors.
So in your latest results, the chairman said that this was a welcome return to form for Ruffer, shall we say. And it means that you're now kind of meeting your objectives over 10 years and over 1 year, but you had that gap in between when performance was less good. Looking back on that, what went wrong in 23 in particular was the bad year, I think, that you had when the trust went down significantly, even at a period when the market was going up. So you obviously learned something from that. What is it you've taken away from that experience?
Yeah, absolutely. So completely right to acknowledge that was a challenging year for us, a negative calendar year return. So not setting out what we look to achieve for shareholders, as you point out, it's an absolute return objective, not a relative one. And I think, like any active manager, there will be more difficult years. 2023 in particular for us was a headwind because we had a lot of protection in the portfolio, as I've just discussed. We'll always have it there for the important moments when it's required. The fact that that wasn't needed in 2023 is not so much the frustration when I look back and reflect. It was really the fact that the growth assets that we did have exposure to didn't do their job. They didn't deliver that positive return when it was required. Reason being that, as we all remember, 2023 and a little bit of 2024 as well, the equity market rally was extremely narrow and very focused around the US, and particularly those tech and AI flavours, of which we haven't had much of in the portfolio, and that's latterly sort of rewarded us. So it was a little bit about the portfolio balance, but also very much about where those growth assets sit. And I think it's been hopefully the right decision, and we've seen that in recent equity market performance, to have held on to those areas that we like and we see really interesting value and a bit more of a margin of safety, places like Japan, China and the UK.
So let's just start at the bottom end of the portfolio with these protection strategies that you have. You have an illiquid strategy fund, and you also have a thing that looks at puts and so on against the equity market. That's around 10% of the portfolio. If I compare that to where you were in 2023, is the actual overall shape of the portfolio the same? It's just as you say that one element of it didn't perform, or have you actually made some more radical changes to the structure of the portfolio over that period?
Yeah, I wouldn't say radical. There's been a few changes at the margin, largely based on where we're seeing opportunities, particularly in the equity space. One thing that definitely has remained consistent is that significant allocation to those unconventional protections. And I use the word unconventional deliberately because I think that's something that really makes Ruffer Investment Company and the trust quite different to some of its peers. They're a little bit unusual, I think, in the world of defensive investing, in that we do actively use derivatives, as you describe. I think that's a benefit of being flexible, being unconstrained and unbenchmarked as we are. And I think it's having access to that toolkit. You mentioned, for one example, index puts, but also that could be volatility call options. That could be credit default swaps, which we think are a really interesting place to hide for investors at the moment. That very much remains in place and, again, has sort of demonstrated its value, particularly in the last couple of weeks. Same as it did in Liberation Day, that was a really important asset for us.
And if we look around at the world today, we know that there's, I suppose you would call him Mr. Volatility himself, sitting in the White House, in the sense that he comes out with a different story every day, and the markets, perforce, have to take notice of him. Would you agree, though, that we are living in an environment which is as volatile as it has been for some time? Or are we just actually seeing the same things going on as have always happened? It's just magnified by the megaphone in the White House, shall we say?
I think absolutely it's reflective of the investment environment that we're now in. And as I'm sure you'll be familiar with, this is something that Ruffer have been writing about, talking about for quite some time. And it's just that today it's blatantly obvious to investors and everybody, you don't have to look much beyond the kind of news headlines to see the fact that we are now living in a much more fragmented and a much more volatile and challenging environment, both for individuals, economies, but particularly financial markets. And I think, to be honest, that's the interesting thing that we can talk about and maybe say about what's going on in the world today with regards to the conflict in Iran. There are so many moving parts to the day-to-day events that are unfolding. So many sort of unknown feedback loops, unknown reaction functions from the various actors, one of which is particularly uncertain and volatile, as you've described. So I think it's really hard to say too much that is useful about the kind of near-term politics or the situation, but taking a step back from that kind of immediate uncertainty, I think the useful thing that we can say or observe is how the current events fit within this new and more volatile world and this new regime for markets, one that's defined by a much more multipolar world order, a much greater real-world volatility, economic fragmentation. And I think what we're witnessing today is a very clear example of the US and China ultimately trying to carve out their own spheres of influence in this new regime. And as I say, that's going to have some pretty significant consequences, particularly for the way investors maybe construct their portfolios.
So when you're looking at that, do you start from trying to get an understanding of what those feedback loops are, what the drivers are, or do you actually start from looking at the assets and how they're performing and their characteristics? In other words, do you try and take it from a top-down sort of view back to the portfolio, or do you actually start with the portfolio building blocks and see how they measure up against the way that the world out there is changing?
Yeah, for us, it's very much thinking about the portfolio, the balance within the portfolio, and where the risks and opportunities lie. And because of our mandate around capital preservation first, we are always focusing on the risks first and foremost, and the opportunities in many ways are a result of protecting against those risks. So I think thinking about today's logic and what's going on, thinking about those consequences to your question, it is really about what this means for asset classes and portfolio construction. And I think what it has done is reinforced our view on the role of maybe hard assets and commodities within portfolios and the role that they can play in this new, arguably more volatile and inflation-prone regime. And clearly, the role of energy as a portfolio hedge has been demonstrated quite clearly in the last month or so. And that's something we've been allocating to for some time and was a very useful asset class in the portfolio through 2022, for example. I think what it also underlines is the less useful or consistent role that conventional safe havens are going to play. One clear observation from March has been that gold has fallen sharply, even though a lot of people perhaps hoped that it would protect through a geopolitical crisis. It's the third time in a couple of years that you've had bonds and equities falling together. And whilst the dollar has been helpful, I would say the reaction's been perhaps a little muted. So I think that's important, and all of that. And you'll say I'm biased, and it's true, I am, but I'll say it anyway. This really underscores, I think, the role that an active manager can play within investors' portfolios.
So you've talked a lot, Ruffer's talked a lot for many years about the risk of inflation and the risk of, in particular, inflation volatility. And I would deduce from reading what you've written in the annual report and elsewhere that you actually think, and you even say explicitly, that 2% is now the floor rather than the ceiling for where inflation might go. And that obviously has a lot of implications for the bond market, if you're right. And that remains, I mean, you talk about a number of scenarios, and we can talk about those, but essentially this risk of higher inflation is very much at the top of your scenario planning, shall I say. Would that be right?
Yeah, I think that's fair. We definitely highlighted in the interim report, in the investment manager piece that we published in January, identifying inflation certainly this year as a key axis of risk for investors. I think for 2026 to have been a benign environment for risk assets, you needed to see prices contained. We're obviously now seeing that contingency tested. But more broadly, I think for us, it's really about inflation volatility. So I think it's fair to say that our view is that there's certainly the risk of higher average inflation, and that's going to be more of a concern for investors. And that's a really tricky environment, as we saw in 2022, and given the way markets have behaved over the last month, that causes asset class correlations to shift when there's a risk of greater inflation. So that matters. But it's the volatility piece that I think is really important, because similarly, through periods of disinflation like we had in 23 and 24, and also to an extent in 25, very different investments are going to make you money through those periods. So for us, it's really about inflation volatility and the idea that the very low inflation, stable inflation, low volatility regime that investors enjoyed pretty much for multiple decades up until 2022, that has now given way to a much more unstable inflation regime. As you say, perhaps 2% now being the floor rather than the ceiling, and sort of the unwind of all the disinflationary forces that we enjoyed, making way for this fragmented world driven by protectionism and perhaps greater fiscal activism.
That would lead me on to then talk to you about bonds, because bonds make up a significant part of your portfolio in the trust. I think it's about half, something like that. And yet this is in a period when yields are rising and we're seeing spreads on corporate bonds and so on are very tight. To be fair, obviously a big chunk of that are index linked. So just talk us through why you have overall there's such a big allocation to bonds, given this kind of volatile inflationary prospect, and why you've weighted those bond holdings in the way you have.
Absolutely. So I think you're very correct in drawing the conclusion from what I've just said there is we are duration skeptics, because periods of high and rising inflation, as we've witnessed, are not favourable to bond prices as you see yields rise. So we are cautious, and that's why it really matters what flavour of bonds actually make up that percentage in the portfolio. And the vast majority of that are very short dated, very low duration, almost cash-like instruments. So they make up about 20% of the portfolio. So overall portfolio duration is still less than 2 years. What we do think is interesting in the bond market currently is short-dated gilts. So the 5-year tenor, for example, and we've very recently actually allocated about 15% of the portfolio out of some of that cash-like holding and into those assets. Reason being, it's been one of the areas that you've seen sort of the most severe dislocation in kind of prices over the last couple of weeks. You've seen a huge move in short rates in the UK. It's sort of the standout globally, as we've basically gone from investors expecting up to 2 interest rate cuts this year to, at its peak about a week ago, potentially 4 interest rate hikes, which is a pretty extraordinary swing in such a short space of time. So that represented a bit of an opportunity for us. And it's partly why we hold such a significant chunk of the portfolio in these short-dated cash-like bonds, because sometimes these opportunities, and we've witnessed it multiple times over the last couple of years, can be quite fleeting. So putting that 15% to good work in those 5-year gilts, which we see at a yield of sort of 4.5%, which is when we were buying, is quite good value. But also, it's not about taking a directional view on perhaps how the conflict plays out from here. It's much more about the asymmetry that we see on offer here. I think it's possible that the extent of that move was somewhat overdone, and I think that partly could be because owning gilts and doing it with leverage was a pretty popular trade at the start of this year. So I think you've partly seen a bit of an unwind of that. But also the fact that I think it's quite likely that you maybe get a bit of that pricing of interest rates calm down from here, rather than the expectation that actually you possibly get even more than 3 or 4 interest rate prices hiked. So we like that asymmetry. But the fact that probably that's a trade that could work in a couple of different scenarios. I think from here, either you see a continued escalation of the conflict, in which case I think at some point investors are going to have to start pricing the growth implications of this shock rather than just the inflation implications. That should help those bond yields start to come down. Or indeed you get a de-escalation and perhaps things look a little bit better, in which case the concerns around inflation perhaps can subside a little. And again, maybe you can see a little bit more favourable pricing for the Bank of England. So it's not taking a view on markets. We are still cautious of duration. I think it should be treated as a tactical asset, but maybe there's an interesting opportunity at the moment.
So do you think that these people who point out that the yield on gilts across the curve anyway is higher than it was during Liz Truss and all the rest of it, you think that's a reflection of just investor behaviour rather than saying anything about the position of the UK in the global financial markets?
I think it's probably a little bit of both. I think the tenor that I've highlighted sort of at the shorter end, I think that probably was more impacted by that positioning piece that I sort of gave the example of. I think it's very right to think about the long end of the bond market, and not just in the UK, but globally. I think it's right that there's some real risk that term premium has to go up given the fiscal positions of most Western governments. And that also feeds into why we've chosen to keep the duration quite short in the portfolio at sort of an overall level.
So in other words, it's not worth taking the risk of committing your money beyond a very few years ahead to the bond market.
Yeah, I think when we talk about duration, I think what we acknowledge is probably the different role that it now has to play for investors. In this old regime, if we want to call it that, of absent inflation risk, low, stable interest rates, really what that meant is that you had this very helpful relationship between bonds and equities, and they offset one another. So when your equities fell in a crisis, your bonds protected. As we've already talked about, that relationship has become less reliable. And for us, what that means is that bonds just have to have a more tactical role in the portfolio and should be viewed as an allocation to a risk asset rather than sort of maybe the buy and hold protective type role that it had in investors' portfolios for a long period of time. So it's not that it's not worth allocating to. There's definitely a role for duration to play, and at times long dated bonds will have a role to play, but it's one that we think needs to be a bit more tactical, and that's how we've been trading duration over the last couple of years.
And we've only seen some hints about how central banks are going to respond to all this. There seems to be some differences in emphasis between the Bank of England, say, and the Federal Reserve. But I mean, the monetary policy is going to be a very significant factor from here, isn't it? And will actually help to shape those, whether it is inflation or slower growth that we get. Would you agree that we don't yet know how they're going to react, or can anyone make assumptions about what their reaction function is going to be?
I mean, I definitely agree. I think monetary policy uncertainty is going to remain significant, and that will be a driver for risk assets and probably a source of ongoing volatility in this year. Markets have been, for the last couple of years, very sensitive to central bank expectations and pricing for interest rates. I think, as you point out, what this kind of current situation does is it creates an uncomfortable dilemma for central banks. Do they choose to contain prices and raise interest rates at the risk of impacting growth? Or do they try to look through some of that inflation, but potentially at the risk of sort of allowing inflation expectations to become a bit less anchored? So it's a delicate situation, and it was already pretty fragile on the way in prior to this conflict, I think. You had, in some places, thinking about the UK, for example, particularly around services, some pretty stubborn inflation at the same time that you had a softening labour market. So what's going on today, I think, is a pretty unwelcome complication and a path that central bankers are going to have to tread pretty carefully.
Yeah, so it's going to be difficult. And when do you think we might actually be able to get a read on how they're going to behave?
The impossible question. I think it's been interesting, from our perspective and thinking about that gilt allocation that we made. It was interesting to see Andrew Bailey in the last couple of days sort of push back against that market pricing. We sort of jumped to a couple of rate hikes this year, and he sort of highlighted or hinted at the idea that actually the bar to that might be pretty high. And as I say, that's sort of where we got comfortable making that allocation, was the view that you already had an awful lot in the price of those bonds. And that's exactly the type of thing that we like to take on.
We talked about gilts, and you own quite a few of those, and you've just been adding to those. If we look on the equity side, UK equities are your biggest exposure there. You had 30% at the end of the last year. I don't know what it is now. North America, 6.5%, Europe, 4.6%, and Japan, 3%, something like that. So that's pretty much weighted towards the UK. The UK market has obviously performed very well over the last 3 years, to some people's surprise. Talk us why you have that percentage in UK and so little in North America. That's a very big contrast to the world index anyway.
It is. So yes, definitely right to point out that that is a significant allocation for us. About half of that, to your point, is actually more kind of global flavours of equity, and probably the key theme within that has been commodity and oil exposed equities. So BP is one of our largest holdings. We've had positions in the likes of Rio Tinto, over the last couple of years. That's been helpful as kind of commodity prices have risen, and particularly at the start of year, they played in quite nicely to the global reflation trade. So UK listed, but clearly not necessarily domestically exposed. But you're right to point out the rest of that allocation has been pretty sensitive to domestic consumers and also interest rates. So that's been certainly a headwind for us over the last month or so, as sort of the UK, as we've just talked about, was sort of been hardest hit by way of that repricing of interest rate expectations. But particularly what we've liked there is flavours like house builders, companies like Howdens, who, so volumes have been very, very low. It's been quite a weak trading environment for them, but they've been investing through the cycle. And the expectation that if you do get any sort of recovery in the UK, particularly in the housing sector, that's a quality business that stands to benefit. What's that view predicated on? Kind of taking a step back from the macro, perhaps, because there's obviously lots of cross currents at the moment. I think our observation in the UK is that what gets a lot of attention, negative attention, is public sector finances. And I think that's right. The government is in a very difficult position. There isn't a huge amount of fiscal headroom. What is in a lot better shape, though, are corporate and private sector, household balance sheets. And they've deleveraged enormously since the financial crisis. And levels of new borrowing, so credit growth, is extremely low. So over the last 50, 60 years, that new borrowing measure has ranged from sort of 0% to about 13% of GDP. And we're currently at about 3%. So we're already at the extreme lower end. So again, it comes back to that point of sort of asymmetry, and can the setup in the UK go from really quite bad and a lot of those negative views sort of already priced into valuations and equities? Can that slight improvement start to make quite a meaningful difference to some of these shares? And it's quite a slightly contrarian allocation, but to your point, actually, subtly, the UK equity market has been doing quite well over the last couple of years, and we see an opportunity for that to continue.
I mean, there's a lot of negative vibes around the UK, shall we say. So you might think the media's got something to do with that. But there's certainly some negative vibes around the UK, and the popularity of the government is very, very low. And we got this multi-party emerging scenario where the local elections will show that things very much aren't as normal in the political sphere. But let's talk also about Japan. I mean, Japan is a very interesting market to me. And the yen, the currency and the equity market are both very interesting. You've got a small allocation there, but it's one of the ones that you've put some money into. Tell me what you think about Japan and about, obviously, the election of their first female prime minister, who talks a good game anyway. What are your thoughts about Japan and how it might evolve from here?
So that's been a part of the world that we've been interested in for a little while, and largely due to the sort of ongoing corporate governance reform that's been driving some pretty tangible change in Japan. And to reflect that, the sort of businesses that we've owned there have largely been the sort of low-hanging fruit that kind of speak to that trend. So high-quality businesses with currently inefficient capital allocation, but are sort of ripe for that to change, and in good position in terms of balance sheet, so net cash. To the kind of more up-to-date news, I guess, in Japan, you'll be following the political developments very closely. And I think what's really interesting, particularly with Takeichi, is that she continued to surprise markets and investors. She wasn't expected initially to even win her party election, and then clearly did. And then as we came into this year, she looked to capitalise on those popular or higher approval ratings and called that snap election, where, again, she actually wasn't expected potentially even to get a majority, and she walked away with a supermajority, sort of 2/3. So that's been kind of very interesting to watch. And it helped us to gain greater conviction, I think, in some of these views in Japan by way of some of her policies around fiscal expansion, pro-growth, even sort of pro-nationalism, maybe driving repatriation of assets back towards Japan. That's sort of been interesting to our minds. Clearly, with the headwinds Japan as an energy importer are currently facing are unhelpful, and we have slightly reduced that position and sort of reflect some of those near-term risks. But I don't think that changes the underlying trend around corporate governance reform that's been ongoing for some time, but is really gaining traction, and businesses demonstrably reflecting some of those changes.
You've talked in your publications about the trend that we were all observing before the Iran war came along, which is people moving their money away from at the margin, away from America into other areas, including Asia. But I don't see much reference to China in what you're doing. That's a conscious decision, obviously, but what does that reflect? Is it a reluctance to invest in China at all, or is it more about the way that the Chinese economy is developing and their corporate sectors develop?
It's really a reflection of how we've reduced the position size that we have had in China over the last couple of years. So we are certainly willing to invest. We're a global investor, we're unconstrained, so it's definitely a market that we've looked at. And it's one that we've owned for the last couple of years. 18 months or so ago, that was more like a 4 or 5% position in the portfolio. It did very well, and actually was sort of a key driver for our equity returns last year. It was about 1/3 of the equity gains. So it's been very good to us. And as a result, we've started to reduce that position size. So it's only about 2% of the Ruffer Investment Company allocation currently. What we've got left in China is quite a deliberate theme, and that centres around some of the AI and tech exposures, the likes of Alibaba and Tencent, with a view that, and actually this slightly ties in to the point in your question around US exceptionalism, one of the pillars that underpinned that for such a long time was the clear tech and AI dominance that the US had. And what's become clear to us and wider markets over the last couple of years is that actually it's not just about the US. There is competition from elsewhere, and primarily that's been driven by China. And that was really brought to the fore with the announcement of DeepSeek at the start of last year. So those positions are reflective of where we are comfortable getting some of that tech and AI exposure at some quite different valuations relative to some of those US multiples, certainly at the start of this year. And that's the sort of flavour of Chinese equity that we still own.
That implies that you have some kind of view of how AI is going to develop. But you don't sound like a wild enthusiast that it's going to change the world, or that the companies which have obviously been dominating the market are the ones to own. That's just because they're too expensive, or the whole thing might not actually work in producing the results that people are hoping for.
Yeah, we certainly agree that AI has got huge long-term potential and is already impacting the way that we work and interact on a sort of day-to-day basis. But we're investors, so we're obviously going to be looking at this through the lens of an investment opportunity. And the reality and sort of the investment opportunity is not always the same thing. And our job is to kind of separate those two things. So what we are skeptical of, perhaps, is both the speed of which some of these changes and kind of productivity gains can take place, but also, as you nodded to, the kind of valuation case for some of these companies. I think what's been really interesting over the last couple of months, and it's been quite easy to forget given the conflict that's going on today, is there's been huge amounts of disruption for certain sectors in the equity market as a result of anxiety around AI disruption. And I think that is very real. That's not an irrational response in certain sectors. But I think our observation was that the sell-off that you did see in software, for example, companies selling off sort of 30% in a pretty short space of time, it did feel pretty indiscriminate. So investors really sort of selling first and considering and doing a bit of analysis later. And from where we're standing, that actually created quite a few interesting opportunities to buy high quality, great businesses at much more reasonable valuations compared to maybe what you've been able to buy them at over the last couple of years. And so the work we've been doing is trying to focus on and working out which of these businesses actually have genuine moats and which of them at their current valuations do actually compensate for the risk that all of this is clearly still very uncertain. And where we landed was the businesses that are most interesting to us are ones that have things like proprietary data that no one else has. That data is going to become very valuable in a world sort of run by AI, which needs good quality, trusted data as one of its inputs. And that led us to allocate to a small basket of some of these software flavors or disrupted AI stocks that speak to some of these themes around data and where the businesses perhaps operate in a sort of more closed and unregulated environment.
For example, can you give us a couple of examples?
Experian would be one of them, and that speaks to the sort of UK theme as well. 200 years of credit data, it's proprietary, it's in a closed environment, it's regulated. You can't really replace that very easily at all. And the work that they do is pretty essential around lending, fraud and ID checks. It's quite likely that a business like that can actually use AI to increase its moats and improve its offering and increase revenues over time. But it's certainly been caught up in the disruption more widely.
Can I ask you something about the trust itself? Obviously, one of the notable features has been that there have been a significant number of buybacks over the last 3 years. Nearly 25% of the market capitalization has been bought back. Now, obviously, that's a board decision, not yours. So my only question about it is, how does that actually impact on the way that you manage the portfolio? You have to manage what effectively a series of outflows, if you like. How do you manage that? And is that actually disruptive to what you're trying to do? Notwithstanding the benefits to the shareholders, of course.
Yeah, absolutely. So, we have a very active, very engaged board. And as you say, that's been evidenced by the scale and consistency of the recent buyback program. It was over 100 million last year, represented about 11% of the shares outstanding. We think it's important to provide that liquidity to help narrow the discount to enhance the NAV per share for remaining shareholders. In terms of, for me, and thinking about portfolio management, something that's really important for us, regardless within the portfolio, is to have meaningful liquidity, particularly in this environment of greater volatility in this new sort of investment regime, because some of the opportunities to step into when some of these risks occur can be very fleeting. We talked about the extent to which we've got short-dated bonds, sort of cash-like instruments. So the portfolio itself is very liquid, notwithstanding the kind of small allocation to some of our unconventional protections. So on the whole, it has been pretty straightforward for us to manage.
Can I ask, just before we get to the end, a personal question, but you don't have to answer. I think it's fair to say you're still relatively early in your career. How do you feel about managing a trust like Ruffer? I mean, it sort of seems a little bit like a kind of, I was going to say, an old person's portfolio to manage. You're kind of thinking about the downside all the time, whereas you're at an age where you can still be thinking about all the good things that could happen over the next 3-4 decades. What is your take? How do you react to that?
Yeah, I think it's a really interesting question. I guess the way I think about our philosophy and our approach is, to your question, a lot of people think about us as purely a bear market operator and doom and gloom and always kind of concerned about what's going on in the world. And I think in part that is fair and reasonable, because as a capital preservation mandate, looking to preserve shareholder capital on any 12-month rolling basis, of course, we're preoccupied by the risks, and there's plenty of them in the world today. But I think what a lot of people forget or maybe pay less attention to is, if you can do that successfully, if you can preserve shareholder capital through periods of crisis, it then puts you in a really exciting position to take on opportunities when others are fearful. And that's really what's driven the second leg of our returns historically through periods of crisis. Is it's not just preserving and growing investor capital through the difficult periods, it's then rotating and re-risking the portfolio into those opportunities, which is really important part of what we do. And that makes it very exciting. And you can sort of be thinking about blue skies and risk-taking and opportunities at very different moments to others. So I think that's kind of worth thinking about. And it's also really interesting to work at a place where curiosity is encouraged, different views. Before we started recording, we talked about the backgrounds of some colleagues having studied very different subjects and coming from very different kind of professional backgrounds. Bringing that together collectively to work on one single strategy, which is what Ruffer do, all of those minds pushing towards the same thing, makes it a really wonderful place to work, and very much believe in what we do and have enjoyed it over the last 9 years.
Some of us who are significantly older, we kind of get scarred by all the kind of crises that we've been through in the past. And one of the things that often drives markets to excesses in one direction or another is the fact that people haven't had that experience before. They haven't lived through those kind of things, which can make you over-cautious, can also make you over-enthusiastic if you don't have that in your kind of memory bank, if I like.
Yeah, and that's where history becomes really important. And it's the other thing that's very embedded in the culture here, evidenced by the library that we're sat next to, stuffed full of financial history books. Jonathan Ruffer would just always describe himself as a financial historian. And having worked with him and lots of our colleagues, that sort of becomes instilled, and we always take a step back and try to look at probably a much longer history than maybe your typical investor. And I think that's really, really important to understand what might be ahead of us, because, to your point, most people operating in the industry today, even if they've had a sort of 30-40-year career, arguably that would have been in actually one environment, one where bonds and equities are negatively correlated, one where inflation risk has been pretty absent, and where we've been over the last couple of years is amidst that regime change. And I think the coming years will probably feel very different to that last 30 or 40 years. So having experienced moments like the pandemic, 2022, Liberation Day, what's going on right now, it's been busy. There has been a lot of noise and a lot to deal with, but it's been a vastly kind of interesting experience and one I think that will be important for the decades ahead.
There's been a sort of crash course in volatility. I can see that. Ruffer made some headlines a couple of years ago. I think you were involved in the early stages of managing the trust at that point because it invested in Bitcoin in and out very quickly, made a lot of money out of that. And I know that you've been asked a lot of questions about gold as well. So how do you regard that? I mean, a lot of people say Bitcoin isn't an asset you can invest in. Or people say gold isn't an asset you can invest in because you can't value it properly. So what is your thinking about that? And you're a younger generation. You've grown up with Bitcoin. Do you own any Bitcoin yourself? And if not, how do you think about crypto and gold as potential investments in the modern environment?
So I think it is a good question to point out because capital preservation trusts, probably cryptocurrency isn't the first thing you think of. So the fact that we did allocate a couple of years ago back in 2020 was very significant, and it was really important for us to talk to our shareholders about it. At the time, our observation was firstly that it was sort of emerging from the shadows and becoming into a much more regulated environment. It started to be viewed as an investable asset class. And if that were to play out, you would probably see that reflected in prices. And at the time, we allocated about $15,000, which feels like a very long way away now. And the other element to the thinking was, could this be an interesting part of our basket of inflation protections, alongside, as you say, gold, which has sort of been historically the inflation hedge to go to, and maybe alongside other things like commodities and index-linked bonds. So that was sort of the rationale for the allocation. What we saw play out over the time at which we owned it was really the former part of that thesis. So it started to be bought by big institutional allocators, and that really did have a quite drastic and quick impact on the price. And we exited at an average price of sort of in the mid-50 up to $60,000. So it was successful. It's something that we've watched very closely ever since. In terms of why we exited, the former part of that thesis played out, but we had a bit of a thesis violation for the second half, which really our observation was that cryptocurrency was behaving much more like a liquidity asset, and it was almost like owning something like the NASDAQ and really not behaving like gold or a sort of an inflation hedge. And I don't think that's really changed since. It does tend to be very correlated with the kind of liquidity available in financial markets. What's been really interesting over the last month or so is the way that it's behaved through this geopolitical crisis. So Bitcoin's actually been positive.
It's been positive and gold
whereas
has been negative.
Gold has been negative, which
Indeed.
is really, really interesting. I think something worth pointing out there is how those two assets had behaved in the months and years prior to this crisis, because I think that's important. Gold has obviously, and wider precious metals have been on an extraordinary run.
Became a momentum trade.
Exactly. And I think there was some investors pretty fully positioned within precious metals. And I think the opposite was true for cryptocurrency and Bitcoin. You saw a real sort of liquidation, sort of positioning wash out sort of the back end of last year. And I think the fact that those two asset classes have moved in opposite directions since are partly reflective of those technical dynamics and the way investors have been positioned. In terms of thinking about gold and perhaps why that's disappointed, there's probably a number of reasons that we can think about. One is, as we've talked about, the impact on interest rates, particularly real interest rates going up significantly. That's been a headwind for the metal that doesn't pay you any income. The fact that the dollar has been fairly strong, again, a headwind for something that's priced in dollars. It gets more expensive for everybody else. And the point on positioning and the fact that often in periods of crisis, you see people sort of de-risking across the board and you're selling assets that are liquid enough to sell, but also particularly ones that have done quite well. So I guess the big question from here is gold a buy? Now it's fallen quite significantly. And what's been particularly hit in March is gold mining equities. And I think we're at a point where it's starting to look interesting. I'm not sure if the selling is completely done. You haven't seen complete capitulation in terms of positioning or in ETF flows. So I think we would be cautious. But gold mining stocks, particularly at these levels, are of interest to us. And we do have about 3% of them in the portfolio. And given how fat their margins have been...
They're making a lot of money.
Exactly. They are making a lot of money. So the oil price going up is going to be a headwind, but they're in such a fantastic position at the starting point that they should be able to withstand it.
So, gold and gold equities could remain in the portfolio in the future. But what about Bitcoin? You sort of implied that basically that thesis has been disproved, if you like, and so we probably won't see that again.
We're unconstrained.
Never say never. Yes.
Never say never, I think is probably the right answer there. It's something we watch very closely and of interest, but not currently in the portfolio directly. Final
question then. We're 3 months in, we've had the first quarter, and you said it's gone reasonably well. How would you describe that, and what does it portend for the rest of the year? for the trust I'm talking about in the portfolio, given the very uncertain macro environment.
As you say, the first quarter of 26 has been a continuation of the positive returns last year. So the NAV up a couple of percent, the share price up a little bit more as the discount has narrowed. And it's been good to see the portfolio continue to weather a range of shocks this year. The volatility in precious that we've just talked about, the AI concerns, the geopolitics, it's not been easy. March itself was a bit trickier following that, really strong first couple of months in the year where our rest of world equities performed very well. And you've seen some of that reverse in recent weeks for the conflict. But that's quite a familiar dynamic for us, certainly in the initial stages of a crisis or a market drawdown, where you sort of take a bit of pain on your growth assets, particularly those rest of world flavors, with protection starting to react, but taking a little bit of time to kick in, because what we're not doing is protecting from every tiny kind of bump in the road, sort of 2, 3, 4% down. And actually, I think it's quite easy again to forget that the S&P was only off 5% in March, the ACWI only sort of 7%. So significant, but we're not talking full on correction and crisis levels. What was really interesting to us the back end of last week, it felt like we were just hitting that biting point for the portfolio where risk assets were continuing to fall and the protections really started firing as credit spreads were widening and volatility picked up. So, very much gaining traction on that side of the portfolio into the quarter end. And I think the key message from us is that the portfolio is very well set up should things get worse from here. And those unconventional derivative protections, are really well placed to perform and deliver positive returns. But at the same time, if we do get a de-escalation and some sort of resolution in the short term, then the equities and the growth assets we've got should respond accordingly.
So that was Jasmine Yeo, who's the fund manager of the Ruffer Investment Company, ticker RICA, talking to me on Thursday. You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. So I also had a chance this week to have a quick chat with Charlie Morris, the founder of Bytetree Research, former fund manager at HSBC, now running his own research and fund boutique. Charlie, I also recall, of course, that before you got into the city, you were in the army for a while. Does that make understanding what's going on with the Iranian war any easier, or is it actually a barrier to understanding it all?
Well, I would sympathise with those troops on their way to the Straits of Hormuz and what they face. I never faced drones in my time, which are pretty scary things for an infantryman. But, I'm not a general. I'm not playing the role of armchair general. I'm just like everyone else, trying to analyse what's going on through asset prices.
I guess my reason for my question was just simply it's been widely observed, and it appears to be the case, that Trump has breached that well-known rule that you shouldn't sort of start military action or wars without having a clear objective in mind. And his, at least judging by his public statement, seems to be vacillating from day to day about what actually he is trying to achieve. And that's, of course, contributed, I suppose, to the general uncertainty that has gripped financial markets since that happened. Would that be right? Is it about the uncertainty, or is it about the physical consequences of the war, do you think?
But I think it's all of the above. I mean, you've got a situation where there can be no doubt that Iran's military is heavily depleted. Their navy's obliterated, their air force is obliterated. And I would think that the morale in the army is probably very low. And there must be power struggles at the top of, what the hell's going on and who's in charge. It's not clear, really, who it is and who America are talking to. But yet they seem to have a very determined guerrilla force left. So if there is an invasion of troops on the ground, so I think that's going to be pretty nasty. And they also seem to be able to keep sourcing new missiles and drones. And the high impact, I think what they've realized is in the olden days, you'd fire the other guy's army. They're not bothering with that this time. They're basically saying, how can I damage financial markets? And so they're going for energy infrastructure, trying to keep the Straits of Hormuz closed through fear and that sort of thing. And this can prolong for a long time. I think that it's a tough place for the military to operate in. The Iranian military regime is still very large. And I think the last bit of this war, the first 90% was straightforward with technology, but the last 10% is potentially unwinnable. And so we need to have negotiations, regime change, and these sort of things before we can consider this some form of victory. The markets are very unsure about what's going on. And as Warren Buffett was just saying to Becky Quick on a CNBC interview, this is a 5 or 6% correction. We're not in it for a 5 or 6% gain, you know?
I do understand that. Exactly. Well, a 5 or 6% correction is not the end of the world, we could say, but it could have different and more enduring consequences for various asset classes. Perhaps we could just talk about gold, because that's obviously something which you are deeply versed in. And you've launched a new product called Bold, which combines Bitcoin and gold in varying percentages. How do you explain what's been happening to the price of gold? Obviously, a lot of people bought it because they thought geopolitical tensions are rising. And as soon as we saw those sort of risks realize, gold went into retreat. Now it's stabilized a bit. What is your take on gold at the moment? And why is it behaving the way it is?
Yeah, well, it's trading on a sort of risk-on asset because it has become a risk-on asset. And I think that gold at $2,000 is a very different proposition than gold at $5,500. And clearly investors jumped on the bandwagon in a spectacular way, particularly last year. And, when an asset price is high and heavily owned by investors, it starts to behave risk on. Now, the long-term benefits of holding gold through uncertain times are not going away. I mean, it's right to be bullish on gold. It's right to hold gold. But to understand that the volatility of gold, normally 15%, is now in the 30s. And so it's now behaving like a crazy investment. And of course, silver volatility touched 100 recently. So this has all gone nuts. And it's because they have been popular investments of late. If gold had come into this war at $2,000 or $3,000 and everyone forgotten what it was, then no doubt it would have a strong bid in March. But I think it's the other way around, and people are liquidating, and whatever's gone up goes down.
Right. But you say there's still a role for gold in people's portfolios. You still, I think, got it marked up as we're still in a bull market of some sort. Do you think, therefore, what happens from here is going to be determined by what happens in Iran, or is it just going to be a case of waiting for the liquidation of speculative positions to be unwound? I mean, we've seen reports that some of the central banks have been selling as well. I don't know if that's the case.
Yeah, I mean, there are other things we can bring in. The dollar's rallied in this crisis. Real interest rates have gone up. That's never much fun for gold. That means that inflation expectations have not gone up as quickly as bond yields. That's negative for gold. There's two more things. As you say, central banks are liquidating in a small way. But that's what they're supposed to do. I mean, gold, you're supposed to buy it for the bad times and then sell it when you need it. That's what the central banks do. So I don't think we should be totally shocked by that. And then you've got the speculative overlay as well. But, for those who like a chart, the gold price never went below its 200-day moving average through this correction, which is quite extraordinary. It just shows you how extraordinarily overbought. I think it was 45% above its 200-day moving average as we went into this war, which is pretty extreme. I think it's a second highest reading ever. You have to go back to the late 70s to see a higher reading.
You've also write a lot about the relationship between oil and gold, the price thereof, that is. What do you think that's telling us at the moment? It's obviously another measure, if you like, that fluctuates quite significantly from one year to the next or one decade to the next. What's it telling us at the moment?
Yeah, well, I think in my last Atlas Pulse, which was published recently, I put the chart. So I did the inflation-adjusted chart in a multi-asset investor piece called What Happened to Oil in 1974. And basically, I showed the inflation-adjusted price going back to 1947. And oil shocks, typically, you'd see on a 10-year moving average of the oil price. If it goes twice that, then we call that an oil shock. We saw that in 1974 and 1980 and then in 2008, which was actually much bigger than people realize. And people don't really talk about 2008 as being an oil shock. They talk about it being a credit crisis. But actually, it was both, and probably an equal proportion in terms of the damage as one brought on the other. But then I looked at the oil price in gold in the latest Atlas Pulse, and it basically mean reverts over the last 80 years. And I think that was really quite interesting to see that. And I'm sad to say that oil in gold is a deep value asset. It really hasn't moved very much at all when measured according to the gold price. And so the conclusions of all that, oil is currently just over $100. And if it went to 150, recession, 200, depression. So I think that is the threat. So the equivalent to 2008 today is $200. Gold, I think, is on the sidelines for this. I don't think it needs to collapse from here. I don't think it needs to spike from here. It's going to react to monetary conditions. So when they start printing money again, which has got to come, given the scale of the debt and how expensive this war is, then things like monetary assets like gold will do well once again. I think it's sort of temporarily irrelevant, that, over the medium term, completely irrelevant.
But the price of oil is not irrelevant, of course. So sitting as an asset allocator, if you like, what would be your suggestion about the role of commodities from here, and including oil? That's a function of taking a view about whether inflation or slowing growth is going to be the worst outcome. Is that right?
Yeah. Well, I think my years of experience in asset management have taught me not to be clever in bear markets. You can try and say, oh, this is still working, or there's a theme that this and that, chase fertilizers, whatever it is. But the volatility of all of these things has gone through the roof. And that's a very dangerous place to be. And so my preferred strategy is to simplify and to diversify much further. And commodities are clearly a part of that. So it's not just the energy markets, which have raced off recently, and we know gold's going to kick in longer term. And there's a counter move of oil. So when oil goes up, gold probably goes down, and vice versa, as we've seen in recent sessions. So there's a natural diversifier within commodities. But then you've got agricultural prices, and particularly grains and things like cotton, which consume large amounts of energy in their production. And these things are all very cheap historically. So, I think to add agriculture to a portfolio makes a lot of sense. And industrial metals remains a prevailing theme. So, to own a decent position in a commodities fund at the moment, diversified commodity funds, makes a lot of sense. Not because you're trying to clean up or anything like that. You're just trying to diversify. And you don't want loads of cash, because which cash do you have? Do you have the pound, which is this is bad, it's going to go down. And so you can buy fewer assets on the other side when the market turns, international assets. And then you've got the dollar, which is just crazy and sort of goes up on a red day for the markets. But at the end of all this, their policy is to weaken it. And so, safe havens, this is the bear market, should we call it, without clear safe havens. The bond market's not working, FX is unclear, and parts of the stock market are pretty dangerous.
Right. So what to do? What are you been doing? I mean, you run a couple of model portfolios for people who follow you. What changes have you been making over the last month, and how does that fit into the way of thinking you've just been describing?
Yeah, so we've got two portfolios of the main product. We've got other things as well. The main ones are the whiskey and soda portfolios. The clues are in the title. Soda's the balanced portfolio and whiskey's the global equity portfolio. And they're both multi-asset, I would describe them as. And the soda portfolio, in a nutshell, embraced more diversifiers such as commodities. We have a position in the yen, which is a risk-off currency. Should things go wrong, the yen has a habit of spending 10 years to halve and 2 weeks to double as a sort of way to think about it. And so I think that's quite an interesting thing to own at the moment. And if things all get better, it's probably not going to go down much because it's so cheap. So I see asymmetry in the commodities. I see asymmetry in the yen. We hold on to our core positions in things like Ruffer and capital gearing, which we've stood by for 10 years, precisely for times like this. And I've reduced equity. So equity's gone down from, let's call it 55% to something like 35%. And I brought in the diversifiers. And so, at this time, I'm far less interested in trying to score points and, smash it in a bear market. That's really not my objective. My objective is just to stay safe and to reserve capital until things cool down. So I'm not doing any crazy trades at all in the soda portfolio. In the whiskey portfolio, I've reduced equities further. They're probably now just under 50% from 100% a month ago. That's the biggest downshift I think I've ever done. We did have huge amounts of money in Bitcoin, crypto, and gold, silver, and those sorts of things, and the miners late last year. We've been steadily reducing that, now down to a core modest position in gold miners. And again, I brought in a couple of diversifiers. I brought in more commodity exposure in energy and in grains, and I bought some yen. So there are some things in that portfolio now that if we did have a large shock, then we'd be much better off than the market. I don't think it would go up or anything like that. Again, that's not my objective, but it's to have capital for when this is over. And that's so important because the best time ever in markets is at the lows. So if we do have a big sell-off, if we're preserved, that's when we make money. We're not trying to make money during the bear market. We're trying to protect ourselves during to have capital to redeploy when it's over. So that's the strategy. It's a very clear one. I think it's a very sensible one. But you just got to be patient and not worry about the fact that if markets bounce and go off to the races, you're going to lag. I don't worry about that at times like this. If you can park that thought, you'll be much better off. So that's what we do. And the clients are fantastic and they're supportive and they get it. I don't think anyone else out there thinking this is a great time to buy the stock market.
I think that would be a difficult argument to make, as you say. Also, in the last couple of years, you've taken a lot of interest in investment trusts. You've been attracted by the discounts there and the fact that there's potential for them to narrow. That's been working, but quite slowly, I think it's fair to say, over the last couple of years. And you mentioned, obviously, Ruffer and capital gearing, but they're, in a way, a slightly separate issue. Are you still looking at investment trusts, or have you been releasing some of those, given the discount narrowing process has been slow rather than exciting?
Yeah, I mean, this won't be news to your listeners, Jonathan, but I think that the concentration of the wealth management industry has left us without a big structural backstop buyer in the investment trust world. They still own lots of it, but they're not buying it in a big way because these firms have become too big. And that's a bit of a problem. I'm very interested in investment trusts, and conceptually, I love the sector. But our client base has become quite large, and so the liquidity is not sufficient outside of the very large ones. And that's a good thing, obviously, commercially, but it's a bad thing for embracing the investment trust sector. But we do own a few names. I'm a long-term holder of AVI Global, which I just think is fabulous. It has taken a bit of a hit recently in the last few months, but I've always been a sucker for a value fund, and I think they've proven themselves over the years. We're also in the BlackRock World Mining Trust in a small position, and RIC Capital Partners we added about a year ago. And I said Capital Gearing and Ruffer, we've both owned them for 10 years. And then the final one I'd mention is BH Macro, which I think they should be on the right side of this. I mean, they're a clever bunch of people based all over the world, highly paid, highly motivated to make the most of markets, and they seem to know what to do. So I would expect them to be a good thing to hold during these difficult times. But again, I've always liked BH Metro, but I haven't owned it long term. I've just traded the discount. We bought it a year ago or something when it was on a big discount. And if I'm right and they do magical things during this period of volatility, no doubt the shares will become in high demand. But there is a bit of leap of faith about will Bremen Howard be right? History says they will be. They won't do anything stupid. They're not going to just put it all into natural gas or something and hope for that's not what they do. They're very risk aware.
Yeah, it's been quite an interesting month from that point of view. All those defensive trusts, because the market has actually not sold off that much. I mean, it has sold off, but the equity market hasn't sold off that much. So their kind of protections against that have not really kicked in a big way. So, the best is Ruffer down just under 1%, I think. And the others are a little bit more than that. But as you say, they're really there for if these crises become entrenched. Anyway, so it's been a very busy period. And final thought, you're not trying to second guess what's going to happen. You're just trying to trade your way through this in a sensible manner. Would that be a fair summary?
Absolutely. And hopefully you don't have to do too much trading. Hopefully we've done most of that in the transition. And I think that me, like many others, were wrong-footed in late February, expecting a lower rate world, rate cuts, bond market finally found its bid. And then the first shot was fired and realized that everything had changed overnight. We went from a low rates and inflation expectation to a high rates and inflation expectation after the first shot was fired. And so things like REITs, we sold our REITs, which even though they're cheap and they're long-term great, they're just not going to work in this environment until you get that sign of the turn. And now you've got the interest rates discussion being, we're not going to fight inflation like we did in 2021 too. We're actually going to cut into this because of the jobs. And the jobs numbers are going to deteriorate, and AI is a big factor, and the big companies are announcing huge layoffs. It's really quite a scary time, war aside. We've always got to remember that the war covers the front pages. What's on page 2 and 3 is often more interesting because it gets forgotten, and the jobs and the AI threat are real. And AI, by the way, I mean, I'm no fan of the stocks that are spending the money, but I have to say the output is really quite remarkable. I mean, some of the things that we're able to do in 20 seconds, which would once take your assistant a day or two, is quite extraordinary.
Yeah, so you would think that has to have some impact on productivity in due course. But it's a strange world. And of course, Wall Street being Wall Street, I mean, earnings are still healthy and going up, according to Wall Street analysts. So there may be a bit of a disconnect coming in due course with that. I mean, earnings will go up, I guess, if inflation goes up. You get passed through and so on. So it's a very interesting period. It doesn't keep you awake at night, but it keeps you busy during the day, shall we say. Let's put it that way.
I'm busy during the day, and basically, if I'm awake at night, I know there's something in the portfolios that's wrong. So I have to reduce. So that's just my sort of instinct is to reduce risk further if I am worrying about it. And when you've got risk levels down to the point when you're not, then that makes sense. I mean, to put it in perspective, the whiskey portfolio at the end of February, simulated volatility was 12%, and the FTSE was 10. The FTSE is now 18, 19, and whiskey's got it down to 8. So that's a sort of measurable way of saying that if there is a big problem, you're pretty damn confident that it's not going to go up. I reiterate that, but you're just not going to get taken out on anything like the way the market will be. But interesting, the FTSE is actually quite strong, being full of oil and mining and those things. So the FTSE is the standout index. But, a couple of points I'd just like to mention. You triggered a thought. We know 708, the S&P 500 just sort of went sideways for a long time. It sort of looks and smells a bit like a bear market, but then it sort of kept going up and kept sucking everyone back in, particularly the middle of 08. And then the final straw was one announcement on Lehman. And so, when you're below the 200-day moving average and the VIX is high, which it has been for the whole month, You don't know when it's coming, but the likelihood is there's going to be an event at some point which tips the market. And that's the worry. And it's completely unpredictable. If it was predictable, it wouldn't be called a shock. So for some reason, we've absorbed the bad news so far, but it's the unknown that I think is quite scary. And then the other point you made about productivity. I mean, AI and productivity, I think is really interesting. On the face of it, of course, if a small business like mine introduces AI, then we become more productive. Yeah, I'm not going to fire anyone. There's no one to fire. There's only a few people here, and we love all of them. But they all can have more output. That's fine. But I think at the national level, productivity, that doesn't really matter very much. I think that the high level, it's the cost of energy, it's regulation, it's taxation, and those things, which are far more structural. And our productivity in the United Kingdom has been falling ever since we embraced higher energy costs back in 2005. It all comes down to that simple decision. And the correlation is absolutely clear. And the divergence between America and Europe, in 2006, when Bush 2 said that, America was addicted to oil and they were going to go for shale. And that's where our energy prices diverged. And that's when the economic fortunes of Europe and America diverged. Until that point, they've been very similar. Growth rates, productivity, GDP per capita. America was slightly ahead, but not massively ahead. And that's the big change, and probably very notable in the UK, but also places like Germany. So, will AI boost productivity at the national level? Probably not. Who was the economist, Jonathan, who said the internet is hugely productive, been a massive boost productivity, and it shows up everywhere except in the productivity statistics? There was an economist who made that point 2 decades ago. And it's true. I mean, we've had the internet for 20 years, and it hasn't shown up in the productivity statistics.
That's absolutely right. Well, on that note, Charlie, I'd like to thank you for your time as always and your thoughts on what's been going on and how you're responding to them. That's been very helpful. I'm sure we'll get a lot of traction with our listeners. So thanks again.
Thank you, Jonathan.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.